In the complex landscape of economic forecasts for 2024, a prevailing sentiment emerges among strategists and investment professionals. A mild recession appears likely. The discourse centers around divergent perspectives, with varying indicators and signals contributing to the nuanced outlook. The chief investment strategist at Briley Wealth, Paul Dietrich, stands among those foreseeing a potential severe downturn in the early months of 2024 for the U.S. economy. He points to a confluence of recessionary signals flashing across different facets of the economy. Notably, Dietrich emphasizes the historical pattern of the Federal Reserve implementing rate cuts in response to economic weaknesses, suggesting that the central bank may act in the event of a severe recession. His viewpoint challenges the current market consensus, which largely hinges on expectations of Federal Reserve interest rate cuts in the upcoming year. Adding to the complexity of these projections, a report on market bets for 2024 introduces an element of chaos. Investment banks and asset managers present widely varying predictions for the stock market and currencies, reflecting a profound divide on whether the U.S. will enter a recession that could have global ramifications. This stark lack of consensus stands in sharp contrast to the previous year, when a majority anticipated a U.S. recession and rapid rate cuts that did not materialize. The strategist at Northwestern Mutual Wealth Management, Matt Stuckey, shares insights that contribute to the nuanced narrative. Stuckey acknowledges the evolving nature of the economic landscape, noting the shift in perception from a quasi-consensus for a mild recession a few months ago to its recent placement in the contrarian camp. Despite the Federal Reserve's growing comfort with inflation's downward trajectory, Stuckey highlights challenges in achieving the 2% inflation goal. The anticipation of rate cuts is met with skepticism, as Stuckey suggests that the market's pricing may lead to disappointment, especially if labor conditions do not exhibit the expected improvement. These divergent views are further illustrated by a report on market forecasts, revealing a scattergram of projections for U.S. interest rates and global asset performance influenced by Federal Reserve actions. The lack of consensus among forecasters suggests that market participants are poised for a potentially turbulent start to the new year. Uncertainty looms over the direction of interest rates, with debates on whether a hard or soft landing for the U.S. economy will dominate the market. Against this backdrop, economists are split on the potential trajectory of the U.S. economy in 2024. Forecasts for U.S. GDP growth average at 1.2%, but the crux of the matter lies in the disagreement over whether there will be economic contraction leading to rate cuts and a weakened dollar. Amundi, Europe's largest asset manager, anticipates a U.S. recession in the first half of 2024, influencing their negative stance on the dollar and preference for emerging market assets. In contrast, Morgan Stanley contends that a recession is unlikely and suggests that the Fed may maintain high interest rates well into the next year. The disarray extends to the stock market, where predictions vary widely. Deutsche Bank envisions a mild U.S. recession in the first half of 2024, anticipating significant rate cuts and a rise in the S&P 500 index. On the other hand, J.P. Morgan sees the possibility of a recession and forecasts the S&P finishing the year at a lower point, while Goldman Sachs downplays the risk of a recession. The dispersion in equity analysts' estimates of S&P 500 earnings further underscores the uncertainty prevalent in these market forecasts. While debates surrounding the U.S. economy dominate the narrative, some investors look beyond this discourse to explore alternative opportunities. Pictet Asset Management identifies undervalued European equities as a significant opportunity for gains, deviating from the U.S. economy-focused discussions. The bond market, often considered a haven during economic uncertainties, presents a mixed picture. PIMCO places a 50% probability on a U.S. recession in 2024, recommending government debt over equities. However, HSBC fixed income strategists set a target of a 3% yield for the 10-year U.S. Treasury by late 2024, anticipating a decline from the current level. Yet others, such as Adrian Gray from Insight Investment Management, argue that government bond markets have already priced in too much, suggesting a potential rise in yields. The overarching sentiment leans towards the likelihood of a mild recession, yet the intricate details reveal a mosaic of perspectives, from those anticipating severe downturns to others expecting a more optimistic trajectory. As we approach the new year, the only certainty appears to be the unpredictability that defines the current economic landscape. And that's all for today. We wish all the audience warm wishes for 2024. Share, subscribe, and hit the bell icon to stay tuned for the latest updates in the dynamic world of economic landscapes.